Profit margin is a fundamental metric that reveals how much of every dollar in revenue a business actually keeps as profit. Think of it as a measurement of business efficiency. It shows how well a company manages its costs relative to its sales. If a company has a 10% net profit margin, it means for every $100 it earns, it keeps $10 as profit. Investors look at these margins to compare companies in the same industry and to see if a business has strong control over its costs. It is important to distinguish between gross margin, which looks at production, and net margin, which considers every single expense a company faces. Different industries have different norms. Software companies often have higher margins than retail stores, which typically operate on thinner margins due to inventory costs. Remember that a high margin can suggest a company has a unique product or brand strength that allows it to charge more than its competitors. Understanding profit margins is a great step toward analyzing businesses like a pro. Thanks for watching and keep on learning.